Imagine you own a regional bank you thought was solid. Then one day you discover that two big commercial loans have gone bad, not just bad, but possibly fraudulent. You take a $50 million hit. Investors panic. Credit markets tremble. That's the scenario Zions Bancorp now faces. Today, we'll break down what happened, why markets are reacting so strongly, what it could mean for regional banks, and what you as an investor or viewer should watch going forward. Here's what we know so far. Zions Bancorp, a regional bank, disclosed that two commercial and industrial loans made through its California unit have major red flags. The bank says it will take a $50 million loss, or charge-off, on those loans. It's also setting aside $60 million for credit losses in its upcoming Q3 results. These provisions represent money set aside to cover potential defaults. Zions is alleging apparent misrepresentations, contractual defaults, and irregularities in collateral by the borrowers. The bank insists this is an isolated event involving two loans and not a reflection of its broader portfolio. To recover losses and investigate, Zions plans to hire independent legal counsel and pursue litigation. On Wall Street, the reaction was instant. Zions' stock plunged around 12 to 13% in a single day, dragging down peers and sparking a sell-off in regional bank stocks. Investors remembered JP Morgan CEO Jamie Dimon's warning just days earlier, when you see one cockroach, there are probably more. The sell-off didn't stop with Zions. The SPDR S&P Regional Banking ETF dropped more than 5%, marking its steepest decline since April. Other regional players like Western Alliance, Hingham Institution for Savings, and Banc of California also took hits. Analysts said it felt like a step on a rake moment, sudden, painful, and confidence-shaking. So why did a $50 million loss cause this much panic? Because it feeds into an already growing fear about the true health of U.S. regional banks. After a string of credit-related losses tied to bankruptcies like subprime lender Tricolor and auto parts maker First Brands, investors are hypersensitive. These incidents are raising alarms about how banks evaluate and monitor their loan portfolios, especially in the complex world of private credit. Another concern is transparency. Many of these loans come from third-party channels or non-bank intermediaries, which can obscure risk. When one bank suddenly reveals a surprise loss, others fear they might be next. That's why analysts often describe these situations as confidence crises, the financial version of contagion. Then there's the valuation side. When provisions for bad loans jump, it hits earnings directly. Analysts have already started trimming price targets. One reduced Zions' target from $60 to $56 a share because of the outsized provision expense. Add that to an environment where interest rates remain high, and smaller banks are already under pressure from slowing loan growth and tighter margins, and you get the perfect storm for a market overreaction. Some analysts, though, are calling for calm. They argue that the structure of these loans should protect banks from catastrophic losses and that the reaction may be overdone. Others say this incident is another reminder that when markets lose trust in the credit system, they punish first and analyze later. To put this into context, let's look at similar cases. Earlier this year, JP Morgan and other major lenders wrote off $170 million tied to the bankruptcy of Tricolor, a subprime auto lender. Jamie Dimon's cockroach analogy came from that event. Then came the collapse of First Brands, the auto parts manufacturer, which exposed banks' hidden exposure to risky or opaque loans. In each of these, the initial surprise loss raised bigger questions about whether banks were tracking their loan quality closely enough. Now, Zions is in that same spotlight. One truist analyst said Zions stepped on a rake, implying it was an avoidable hit. Others say that while the bank's controls may have failed in this instance, it's still too early to assume a systemic problem. But given the pattern, fraud at one bank, lawsuits at another, and rising provisions across the board, the anxiety feels justified. Looking ahead, several outcomes are possible. In the best-case scenario, Zions proves this really was an isolated event. The loans were fraudulent, yes, but unique. The bank recovers part of the money through legal action, and confidence returns. In a moderate scenario, more irregularities emerge. The investigation finds that underwriting or oversight weaknesses extend beyond 2 loans. Analysts cut forecasts further, and other banks with similar lending practices take provisions of their own. In the worst-case scenario, this turns into a broader confidence shock, multiple banks reveal hidden losses, credit markets seize up, and regulators step in with emergency reviews or capital requirements. We're not there yet, but history shows how quickly sentiment can turn when trust erodes. Here are the key things to watch. Will Zions disclose more details about the borrowers and collateral? How much of the $50 million can it recover through lawsuits? Will other regional banks make similar disclosures in their upcoming reports? And perhaps most importantly, how will regulators respond if this pattern of isolated frauds keeps repeating? For investors, this is a reminder to stay alert but not panicked. Zions reports Q3 earnings on October 20th, and that release will be crucial. Pay attention to other banks' provisions, the tone of management commentary, and any hints about tightening lending standards. Watch the regional banking ETF as a sentiment barometer. If it stabilizes, the market may be regaining trust. If you hold regional bank stocks or ETFs, review your exposure. Diversify, consider trimming high beta names, and understand which institutions have more commercial loan exposure. But don't automatically assume every regional bank is sitting on a time bomb. Most have stronger credit monitoring than during the 2023 mini-crisis after Silicon Valley Bank's collapse. And remember, individual depositors remain protected. Even if a regional bank faces financial strain, FDIC insurance covers standard deposits. The bigger issue isn't safety of checking accounts, it's the health of credit flows that keep small businesses and local economies running. So, to wrap up, Zions' $50 million loan loss is more than just a blip, it's another warning sign in a series of credit surprises that are testing confidence in the US banking system. Whether it's one unlucky incident or the start of something larger depends on what's uncovered next. The bottom line: banks, investors, and regulators all need to take Jamie Dimon's cockroach comment seriously, because in finance, what's hidden in the dark can spread fast. If you enjoyed this breakdown, please like, subscribe, and hit the bell so you don't miss updates. Drop a comment. Do you think this is an isolated issue, or a bigger banking problem waiting to surface? I'll be reading your thoughts and might do a follow-up video after Zions' earnings call. Thanks for watching, stay alert, stay informed, and I'll see you next time.